You've probably heard people say the market is anxious or fearful, right? But what if you could actually put a number on that fear? Well, it turns out you can. And the secret isn't hidden in the headlines, it's in the complex world of the options market. So today, we're going to pull back the curtain and demystify the market's fear gauge.
Okay, take a look at this. This is what people call the market's fear gauge. And just look at those dramatic spikes. They line up almost perfectly with huge crises like the '87 crash, the 2008 financial meltdown, and the 2020 pandemic. In these moments of pure panic, this gauge just shoots sky high. It's like a real-time EKG measuring the market's collective heartbeat.
So what exactly is this thing? It's not based on some poll of experts or a bunch of tweets. No, the information comes from a really powerful and honestly often misunderstood financial tool, the option. If you can understand what an option is, you unlock the whole mystery. So let's start right there with our main clue. At its heart, an option is just a contract, a bet on a future possibility. It's a deal that you make today about something that might happen down the road.
Now, there are two basic flavors. A call option gives you the right to buy something, like a stock, at a price you both agree on today. Just think of it like you're calling it over to you. On the flip side, a put option gives you the right to sell at a set price. You get to put it onto someone else. Now that phrase, the right but not the obligation, that's the secret sauce. It means you have a choice.
Let's make this real with a simple story. Imagine a developer thinks a farmer's field would be perfect for a new supermarket. Instead of risking millions to buy the land right now, she pays the farmer a much smaller fee for an option, the right to buy that land within a year at today's price. See? She's locked in a great price, but she's also bought herself time to make sure it's the right move. That's an option in a nutshell.
Okay, so we know what an option is, but how in the world does its price tell us anything about fear? Well, this is where the magic happens. The price of that option contains hidden information, a clue about the future. And here is the absolute key to understanding this. As Professor Robert Shiller puts it, an option has a non-linear relationship with a stock. What does that mean? Well, a stock's value just goes up and down in a straight line. But an option's value has a kink in it, a break. Its value behaves totally differently depending on where the stock price is. And that little kink is what makes it so incredibly powerful.
Here's the first part of that kink. Let's go back to our developer. Imagine her option has a strike price of $1 million for the land. If, on the very last day of her contract, the land is only worth $800,000, well, her option is worthless. Why on earth would she pay $1 million for something that's worth less? Her option is out of the money. But what if the land value skyrockets to $1.5 million? Whoa, now her option is incredibly valuable. She has the right to buy for $1 million something that's now worth way more. It's in the money, and its value now climbs right alongside the land's price, dollar for dollar.
And this is the part you really gotta get. Even when an option is out of the money, it's not free. It still has a price before it expires. Why would anyone pay for it? Because there's always a chance the stock price could suddenly move and make it valuable. That chance, that possibility, is what we call option value. And that's what people are really paying for.
And that chance is our big reveal. Because the price of that possibility is directly tied to how much people think the stock price is going to swing around in the future. We're talking about volatility. And that is the secret we've been looking for.
This all brings us to the 1970s, when a mind-bendingly brilliant formula came out and just changed the game forever. It's called the Black-Scholes model, and it's basically a recipe for figuring out the fair price of an option. It was so revolutionary, it won a Nobel Prize.
So think of this formula like you're baking a cake. You have a bunch of ingredients you already know. You've got the stock's current price, the option's strike price, how much time is left, interest rates, but there's one secret ingredient you have to guess: volatility. That's the sigma symbol. It's how much you expect the stock's price to swing in the future.
Now, this whole recipe only works because of a really powerful idea in finance called no arbitrage. Shiller explains it perfectly. It's like saying there are no $10 bills on the pavement. In a healthy market, there aren't any risk-free profits just lying around for the taking. If a price is wrong, somebody somewhere is going to grab that opportunity in a split second, and that action pushes the price right back where it belongs.
Okay, now here's where it gets really cool. We can use this recipe in reverse. See, we know what people are actually paying for an option in the real world, right now. We know all the other ingredients in our recipe. So, we can work backward and solve for the one thing we don't know: volatility.
We can figure out exactly how much turbulence the market collectively thinks is coming.
And bingo. That's our answer. That number we solve for is called implied volatility. It is the options market's real-time collective guess about future chaos. And this number, calculated from thousands of options on the big S&P 500 index, that is the VIX. That is the fear gauge.
So now that we know where this number comes from, let's circle all the way back to that chart from the beginning and see what it really tells us about the history of market fear.
When we look at this chart again, it feels different now, doesn't it? We understand that each one of these spikes isn't just a scary headline. It's the result of thousands of trades. It's the market screaming through the price of options that massive, unpredictable swings are on the horizon. People were paying huge amounts of money for the chance of a big move, and that revealed a deep, deep uncertainty about what was coming next.
Now, let's zoom out, way out. This shows the actual historical volatility of the market for more than 100 years. And you know what you see? Besides the Great Depression, which was just this massive decade-long storm, the market's turbulence has been pretty stable. The level of volatility in the late 1800s looks a whole lot like the late 1900s.
So what's the big picture here? The key takeaway is this. The market story isn't one of constant chaos. It's actually a story of long stretches of relative calm that get punctuated by these sudden violent storms of uncertainty, just like we saw in 2008.
And that leaves us with a final, really critical question. The VIX gives us this amazing real-time window into the market's anxiety. It shows us when the market expects a storm. But it can't predict the truly unpredictable things. The black swans that history tells us are always out there. The fear gauge measures the price of fear, but it can't eliminate the uncertainty itself. That's what traders are watching every single day, and now, so can you.